Hello, my name is Alex and welcome to my channel. And in this video we're going to be discussing a trade that I just made today, and to help you understand how to trade options and how to make a high probability trade. So this is the SPY chart, and this is where I made the trade, and the trade is very simple. It just sold a naked put, and in options there are only two types of options. There are calls and there are puts, and you can either buy them or sell them. And what I did is, it was a bullish strategy, so I am betting that the price is going to go up, and to do that I just had to sell a put. So in options, if I want to be bullish, I can either sell a put or buy a call, and if I want to be bearish, I can sell a call or buy a put. But it's always better to sell options rather than buying them. Most people lose money, and it's because they focus in buying options. So here I'm gonna be talking about selling them, and it's a lot easier because the probabilities are in your side. So this is how the trade looks. This was the price, and what I did is I sold the 254 options, put options around here, and I got $4 for it. So if this is the strike price, in options you can choose whatever strike price you want if there are options selling, and these are the different prices that we have here, and I'm gonna show you in the platform so that you can visualize it better. But to see my break even, I have to also add what I got. I sold it for $4, and each option equals to 100 shares, so that $4 equals to $400. So if I make money, the maximum amount I can make is $400 in this trade. So let's go to the platform to see how it looks. So here we are in my trading platform. Using Tastyworks as a broker for this example, and as we can see in the activity of today at 3:46, I was filled at $4 credit, and I sold one put, the 254 strike price of 43 days to expiration. So if we go to trade, and this is the option chain, so this is where you can choose what do you want to sell or buy. So, and these are the dates: 15 days, 43 days, 71 days, 99, whatever you want, up to 771 days. And SPY is one of the most liquid products, and usually the best time frame to choose, or the best date to choose, is around 45 days. So if we open the 43 days, which is closer, it might not be perfect, but it's close enough, I can open this one, and it opens up all the option chain. So this might be a little intimidating, but I'm gonna try and explain it as best as I can. So this center column, these are the strike prices, the one that I just showed. So these are the different prices, right? So which one to choose, I'm gonna be talking about that, but first, this is the one that I got, the 254, and you can see here is my position. And on the left side, all these are calls. You can see here, calls, and on the right side, all of these are puts. And remember, I wanted a bullish strategy, so I wanted to sell a put, or I could have buy a call, but again, I don't like buying options, I like selling them. So if I want to sell an option, I can just click on the bid, and if I want to buy it, I just click on the ask. So for example, let's say I want to sell the 258, and this is the price that I will be getting for that strike price. If I wanted to buy, I will have to pay this price. So let's see. If I want to sell this one, I click once, and here it gives me the price. So $3.59. If you multiply it by 100, it will give you a maximum profit of $359. And here you can see the max loss of $25,000. So that might be scary, and that's why a lot of people may say that, you know, options are very risky. But in reality, what it's saying is that if you get assigned and SPY goes to 0, that's how much you will lose. And of course, it's not realistic. It's not going to happen. But still, it's good to understand, and they put it over there just to help you out. But the good thing about this platform is that here you can see the probabilities. This trade gives you a 78% chance to make money, and the closer you get to the money, your chances go down, and of course your profit goes up, right? And again, if you want and to win 90% of the time, you can do that, and you just can grab it and go up until you get to 90%. But you will get less money. You will only get $184 instead of the $500 that you will got on the other trade. But let's stick to the example that I did, and I chose the 254 strike. Why that strike? Well, it depends on what you want. In terms of if you're using charts, or if you're using probabilities, or if you just want a specific credit, then it's up to you. I like using the deltas. These are the Greeks, but I usually go 20 or 30 deltas, so we'll be around here. If I were gonna do the same trade, when I did it, it was around here, where I got $400, right? But at the end of the trading day, it went up, so I'm making money. But let's see an example of the trade that I just did. So if I did a $4, the good thing about this is that you can actually visualize the trade better. So let's see here in the curve, this brown line is the expected move. So this is the option prices give you the expected move of the stock during those 43 days. It was 43 days. So in 43 days, it's going to expect most of the time, around 60% of the time or so, it's gonna stay between these prices. So if I can sell a put below that expected price, then the probabilities is on my side. So you see the green part is where I make money, and the red part is where I will lose money. And if you want to visualize it in terms of the profit, this is how it looks. Let me use the one that I actually have. So this is where the price is right now. We are almost at 270. So as long as the price stays above 250, I'll make $400. So even if it goes to 320, I still make $400. So that's my cap in terms of what I make. And if it goes down, when it goes to 250, then I start losing money. You see that I start losing 200, 300, or 500, and so on, so on. So if you continue to go down, then I can lose a lot of money. So there are other things that you can do to mitigate that, but that's for another day. But let's visualize this again now in the chart. So here again, let me add the expected move, and this is how the expected move looks like. When I sold it, it was around here, the price. So that's why I'm winning right now, because it went up at the end. And this is the expected move, and my break even is outside that expected move. So that's why it's a high probability trade, and that's why right now, over 70% of the time, I will make money. Even if I'm wrong, and this goes down, let's say it goes down, if it doesn't go down very fast, then I'll still make money. Even if it goes down and then goes up, and when expires above my break even, I'll make money. If it expires above my strike price, which was $254, then I'll make the $400, right? So hopefully that that clears things up. Anyway, you can check the trade. I posted the trade in Tradingview, and you can check it out here. This is when I posted what it was. In a couple of days, you can actually click the play button and see how the trade goes, and you can see my if I have to update anything, but then I can write down if I'm starting to do any defense or whatever. But the good thing about this is that when you play the new bars, then you can see if I make money, if I lose money, and how everything was. So let's see a couple of trades that I already made, how they went. So for example, let's say this trade. So this was a neutral trade, right? So I was betting that the price was going to stay between in this zone, right? So I can hit play and see if I make money or I lost money. As you can see, in this trade, I made money because it never went above my break-even or below my break-even, right? So that's another thing about options. You can be very flexible and do whatever you like with it. So hopefully this video was helpful. If you like it, you can subscribe and like it, and hopefully I continue to make more videos and help you to improve your trading. Thank you very much for listening, and take care.